10-year note Treasury yields remain in their range, hovering at about 205. Recall at the beginning of the month, we got as low as 193 in 10-year note yield, and not too long ago, we got as high as 214. So we're still hovering and spinning our tires, waiting for something to nudge the market or push the market towards those extremes. And I think at this point right now, the market is more fearful of lower yields, but I think is holding out some optimism that things will normalize and yields will creep higher. A lot of that's going to contend on the data that we have. A lot of that's going to contend on global central bank meetings. And obviously, a lot of that's going to contend on what happens in some of the exterior markets. If you look at the equity market, which continues to outperform and look very strong during earnings season, any crumbling of that foundation would obviously be very bullish to bonds. But if we continue to see stocks do what they're doing, I think it takes some of the fear, some of the angst away. One of the reasons that we're back above 2% yield, one of the reasons why we continue to trade the current range. And if you look at market volatility, well, market volatility seems to be in decline. It is hovering near the 14-day moving average, so we're not seeing any significant breakout there. I think with upcoming events, you could start to see maybe things firm slightly, but historically, really going back over the last several years, market volatility has not been influenced by single events. Obviously, it needs an underlying price shift in order to see volatility move, and that's what we have seen when bond or when Treasury yields came down significantly. We started to see volatility bid, and then when things normalized and yields stopped going down and crept back higher, volatility came off. I think if we do test those low yields again, that we will see volatility go higher, but I don't think it's going to take a buildup or an anticipation of an event to do it. It's going to take the actual reality of the move. And lastly, we do have some things coming up ahead that are significant. The ECB meets on Thursday. Now, while the ECB has been pretty much stuck with their rates near zero, they pretty much have been in some kind of asset purchasing program. I think that there was some optimism that maybe they would not have to add to it, or they would not have to increase it, maybe just hold steady and hold status quo. Obviously, there are some issues in Turkey. Likewise, there are some growth issues, and I think that the ECB is going to be behind even more asset purchases as they look forward. Remember, this is going to be one of Draghi's final meetings. He will be in the office until October, but so he doesn't want to really go out with a lot of momentum, a lot of easing momentum. Hopefully, he can slow down and let Lagarde take over and get her own plan in place. But at this point, it looks like they may be looking to do more quantitative easing than less, and that could be troublesome. Likewise, we have the Federal Reserve meeting next week. That'll be the big cherry on top of these central bank meetings and what we've been expecting, I think, for the last several months. Yes, the Federal Reserve is going to cut rates 25 basis points, but what will they do next? Market always wants to know what is going to happen next. What have you done for me lately is great, but what are you going to do for me down the road? And I think at this point, Powell's press conference that will come after. We won't get the forward guidance we typically get at quarterly meetings, but we will get a press conference. What is his forward guidance for future FOMC meetings, specifically in September? Because right now the market's priced for 50 basis points of cuts between now and September. If we get 25 in July, we should expect another 25 in September, but maybe that doesn't come. Maybe the Fed's more aggressive, and then there is still another 25 basis point cut priced by the end of the year. So certainly the Fed has its hands full. If it only wants to cut one and done, they have to kind of ease that into the market. This will be Powell's first chance to do that. Likewise, I think they'll keep it open with words like patience and data-driven in order to buy themselves some time to see if the economy does recover, because don't forget, between those two meetings, we get the advanced GDP for second quarter in the U.S. that is expected lower than the last previous we've had. And I think at this point, anything below 2% will be a thorn in the Fed's side to have to more aggressively cut. Likewise, if we get a 2.5 or higher, that could maybe give them a little bit of freedom to do a one and done and wait and see what happens. So at this point, there are still some uncertainties, but we will get one thing for sure, and that is we'll get ECB and the Fed within a week, and both will have significant outcomes to the market.